Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Good afternoon. Welcome. This is Money Matters with Greg. I'm Greg Farrell, CEO and owner of Fair Wealth. It's a wealth management firm here locally in Valparaiso, Indiana, and broadcasting on WVLP here today at 103.1 FM. We love our WVLP family. I highly recommend everybody listen in on multiple different shows. You can find them at WVLP.org and many of the shows there. Listen in throughout the days. We are broadcasting at Thursday at 1 o'clock and then replayed again on Saturdays. And we also podcast anywhere you pod. You can find us Apple, Spotify, YouTube, and then also on our YouTube channel. The show's Money Matters with Greg. We talk money on this show. And today we're going to talk about how some recent changes in the landscape of the Federal Reserve are going to affect you and how they might be able to affect you. So wanted to preface that. We're going to talk about the past and the future in regards to the Federal Reserve. I just did a blog post on this. You can find this find the blog post on fairwealth.com. It's basically the skeletons of what we're going to talk about today. And ultimately just kind of give you an update. The reason we talk about money on the show is to help you save some money, invest some money, grow your money, protect your money, and ultimately be very, very wealthy and ultimately in retirement, walk towards sunset and enjoy a fantastic retirement because you've planned ahead, you've made a plan. All these things we talk about on this show as far as getting the nuggets together, ultimately the rocks, what we call, that you ultimately have to push out of the way in regards to your retirement and things that you need to be able to make sure that you're doing. We try to help with. So we have lots of guests on this show. You can find us most of the shows through wherever you pod, but then also on the YouTube channel at Fair Wealth. This will be 189th episodes. We're working our way up to 200. Hopefully we'll get that certainly done by the end of the year. I want to thank WVLP. I highly recommend as a community radio station that you help support them as much as you can. You can check out more at WVLP.org on ways to be able to help. And certainly you can contact me as well. Greg at Fairwealth is my email. Greg at Fairwealth.com is my email. And I'd love to hear from you. If you have any sort of questions or anything else you'd like to talk about in regards to topics on money, I'd like to have me kind of review and whatever it might be, let me know. Always looking for new ideas and great content out there. I want to just quick house cleaning. Happy Father's Day to everyone that was out there that is a great dad. I was lucky enough to have my three together for a few days over the weekend, and it was just it's a blessing. As we all know, as they get older, it's very difficult getting them all together, and that was quite a blessing. I really enjoyed that. I try to be the best dad I can possibly be and be a great dad all the time, and there's some great competition of great dads out there. I had one. So I hope you have a great dad. I hope you're being a great dad for sure. And happy Father's Day to all. I also want to thank all of the World Cup Europeans that have come into America and blessed us with their presence and their updates. I tell you, it's been a joy. It's been something none of us, I don't think, really saw coming in regards to the happiness that many of them have portrayed about our country and just the fact that we are trying to be the best hosts we can be. And hopefully they have a great time. I really enjoyed Tartan Army. Big shout out, Freddie77 as well. He's another great follow. I highly recommend you follow him as he treks around trying to find his host Germany. And also just as a fan, he's quite the follow. And many of them, I'm sure you've seen him at Buc-ee's all the way down to New Orleans and Texas, the West Coast, obviously Seattle. Congratulations to our USA men. They're doing great. And it's just been a joy to watch. It's been super fun to have sort of a respite from the sports world for the first time in a while. And I just want to throw that out there. And then also, we're going to be running into the celebration of July 4th with the 250th anniversary of our nation very excited about that. There's a lot of America going on right now, and it's very positive, especially in the stock market as far as just moving forward here. As far as the economy goes, we've had some really good, solid growth numbers, which I've alluded to in the last couple podcasts. But today I wanted to do some sort of talk about how important the Fed is and how the Federal Reserve is to you and what's changing in regards to the way it's been, the way it is. And that's really what I want to talk about today. So 2 Fed eras. Let's just be super basic and simple. You've got Greenspan's legacy and the future under Kevin Warsh. So Kevin Warsh was just nominated and, basically passed. He's officially the new Fed chair. And Alan Greenspan, he always once said, I always remember this quote, is, "Since I become a central banker, I've learned to mumble with great incoherence." And that is funny because this man was basically followed from 1997. He's recently passed away at the age of 100, so rest your soul for sure. Served as the chair of Federal Reserve from 1987 to 2006, which is, number of presidents, number of different administrations. It's become one of the most influential economic figures of our 20th century. And as you really reflect on his legacy, just days after and weeks after Kevin Warsh was he just chaired his first Fed meeting, the parallels between these two leaders really highlight there's several changes in how the Fed might operate in the coming years. And that's what I want to talk about today. So connecting the Fed's past to its future helps kind of clarify how investors should view monetary policy going forward. Greenspan leaves a very complex legacy, bookended by really a long period of stability after the crazy inflation of the 1970s and the early 1980s. So that's on the one hand. And then in the housing bubble, the global financial crisis is really on the other. So throughout this timeline, it was undeniable that he helped define the role that the Fed still plays today. And I'm here to tell you, it's changing. So that's why we wanted to be able to mention this today. And perhaps it's really no coincidence that Warsh's vision of the Fed echoes aspects of Greenspan's era, which favored less explicit communication. Less explicit communication. Fewer policy hints. No hints, or forward guidance. Like if you remember him with the briefcase that CNBC made famous, everyone wondering about what's in the briefcase. What's in the briefcase? That's what I basically grew up with. And then in the pits in Chicago when we were trading, we would always have Greenspan watch on TV, and the belief that there's a narrower balance sheet and a narrower focus on core mandates is something to consider because that's the way it was, and Warsh has certainly taken it sort of the same way because it's been the wild, wild west for a while. And I've been very open about how frustrated I've been with many Fed chairs and Fed chiefs openly out on X and openly out on different social medias and broadcasting comments and having press conferences. And, look, it didn't happen during Greenspan, and now it does. It happens all the time, and it's annoying because they act like they actually have some sort of voice and they have some sort of, they should work as a team. And, they work for us and they should work as a team. So that's my opinion. And that's just not the way it's been for a while. So it's really important to remember that the economy and the markets have grown under different leaders at the Fed. This is really because the Fed does not control many of the underlying drivers of the economy, such as technological innovation, demographic trends. And so as a long-term investor, how should investors view the latest changes at the Fed while kind of keeping that history in mind? So when you're looking at this, the economy has grown under Fed chairs. It's important to remember that the Fed has not always operated the way it does today. And many of you are going to know any different because Greenspan, he retired in 2006. So some of you as investors, were born in the 2000s. You don't know what this is. It's just normal for you to see whatever's been going on for a while. And really, for much of Greenspan's tenure, the central bank did not even announce its rate decisions publicly. They just changed. Instead, the Fed would effectively operate in secrecy, and markets were left to infer what would happen by watching short-term rates in the money markets. And now, when it did issue its communications, the language was difficult to understand, something that economists refer to as Fed speak. It was not until really 1994 that Greenspan kind of introduced the practice of issuing statements when rates changed. And even then, the statement was extremely brief with little explanation. But as this practice really started to take hold, the Fed started including language that partly explained its decision-making process based on the economic environment. Now, this continued to evolve over the next 3 decades. So over 30 years, the Fed's modern use of press conferences and dot plots and forward guidance was developed under Ben Bernanke, Janet Yellen, and Jerome Powell. Now, many of these policies were driven by economic crises. You've got, including the 2008 and the 2020 crisis, during which the Fed really believed that communication was an important tool for restoring confidence in the financial system. Now, despite the many different views on how the Fed ought to operate, the different charts you see and everything else you'll see on our website, on the blog, you'll see the charts that I bring up. The Fed leaders really have navigated unique challenges and really set up their playbook for successors, hopefully. The economy has continued to expand over an extended period of time, despite different approaches to monetary policy and varying relationships with the White House. Now, Warsh's approach marks a shift in communication. And that's what I want to talk about. So while the purpose of these communication challenges was also to enhance transparency about how the Fed operates, Warsh and others argue that the pendulum has swung way too far in that direction. So at his first FOMC meeting in June, and this is telling for all of us, this is why I bring it up in this show, Warsh made several changes. The Fed statement was significantly shortened, removing much of this boilerplate language that's been there for years. Any forward guidance, quote unquote forward guidance, meaning the practice of signaling what the Fed might do at or future meetings, was totally removed. He totally took it away. Warsh also declined to submit his own forecast to the FOMC's summary of economic projections, a sign that he does not view these numbers as helpful at all. So that was different. So now that was all really important because that was basically 3 huge changes. He's coming in, he's able to do what he wants to do. He's the chief. So what do you do? But probably most importantly is that Warsh announced 5 working groups to study different aspects of the Fed operations and policymaking. So that's totally different. So 5 working groups. Now, inside these will include communications, the data the Fed uses across the economy, its inflation framework, the impact of AI and technology, and the overall balance sheet. So there's your 5, and these are all in line with Warsh's previously published views on how the Fed should operate, is basically have 5 working groups study different aspects of Fed operation and policymaking. It makes a lot of sense. We'll see how it works. But again, for long-term investors, perhaps the most interesting area is around the productivity growth driven by AI. Now, as you'll see in the charts in the blog, when you go to fairwealth.com and check it out, under blog, the productivity of growth really has been certainly uneven across many decades. We can agree upon that for sure. Now, with this notable acceleration during the technology-driven expansion in the 1990s, dot-com boom, dot-com bust, productivity is very difficult to measure accurately in real time. And even small changes can result in big differences in overall economic growth because they really kind of compound over time. It's so much easier to obviously look back and see where things were and how things were going than obviously where we were in the moment, for sure. Now, this matters because in simple terms, productivity allows businesses to produce more with less labor. So as a business owner, that's all you ever want is more with less labor, more productivity, more opportunity with less work or working smarter. Lots of different ways to put it, however you want. But while much of the AI discussion is rightfully focused on jobs and disruption, in the long run, productivity is what enables wage growth and rising standards of living to happen. So with AI comes a better way to live and a better living standard. That's why it's the future. And that's why in adapting it, incorporating it into your life is definitely going to be something you're going to want to do because it will make your life better, hopefully, if you're used the right way. So technology can also help to keep inflation under control if it truly reduces the cost of producing goods and services. If it costs less to produce something, then there is no pass on to the consumer, like was what has been happening here as prices have been rising. Ultimately, those those prices have been then pushed on to the consumer. So that's a lot, right? And again, shows Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm, financial advisor, and helping clients from all states, 25 states, manage their wealth. And these conversations we have with our clients, I like to bring to you here on the show. We're broadcasting on WVLP 103.1 FM right now, and that's on Thursdays at 1 o'clock, and then also on Saturdays at 1 o'clock on a replay. We broadcast every week, and thankful to have you here. We talk about money on this show, and today we're talking about the Federal Reserve's changing of leadership. So that's basically just the rundown now. All of that I just went over was a lot, right? So lots of changes, many things for us to all kind of digest and figure out as investors and as money managers. And these all have significant implications on monetary policy. And that's what the Fed's in charge of. So in the near term, the Fed has been managing a challenging period of inflation, which has happened, obviously, with the ongoing war in Iran. It still continues to create uncertainty around energy prices. However, recently, we've dropped from over $115 a barrel to right around $73 a barrel. I don't know if you checked out your gas prices, but here in the state of Indiana, they are looking much better. And I think looking much better across the nation as well as we finally come to a resolution here and get this over with and basically bring home a lot of the oil because we are a net exporter as a nation as of today and hopefully in the future. So we have the oil, might as well push it out, might as well sell it. So oil prices, in our opinion, are going to be trending towards $60 a barrel, more than they are going to be trending towards 100. So right now at 73, we see downward pressure than we do, and then upward, just so you know. Just following the news and following what's going on there on the geopolitical side of things, certainly things look like there's more pressure on the downside than the upside. But the Fed has to watch all of this, and that's what we're talking about today. The latest Fed rate projections really show that the committee is totally divided on energy and divided on rates. Well, like roughly half is expecting rates to remain at the current levels by year end, and the other half is expecting them to move higher. And the reason is because we're doing well. Our economy is moving it's very healthy in regards to a number of things, even in spite of things that are blocking us from growing. And that's, a number of things, including the war, which is hopefully soon to resolved. The next thing that's very important is the Fed's balance sheet remains in a focus. Now, interest rates are not the Fed's only policy tool. As the chart that I have in the blog, you'll see the Fed's balance sheet stood at less than $1 trillion before the 2008 financial crisis. And then it expanded dramatically during the several rounds of asset purchases that happened during the crisis. Now, in times of crisis, the Fed has directly purchased bonds at the open market. Now, that's primarily treasuries and mortgage-backed securities. And this provides liquidity to the financial system and effectively lowers interest rates, which is also why the Fed is sometimes known as a lender of last resort. Today, the balance sheet stands at $6.7 trillion. Now, that's down from the peak in early 2022 that was nearly $9 trillion. So things have changed for sure. Obviously, there was an election there. There was a shift in regards to the balance sheet. There's also, we're coming out of the financial crisis as far as COVID. That has been certainly helpful, but we had $9 trillion on the balance sheet of the Fed just recently. And the way it looks now at 6.7, it's going down because Warsh is determined to get assets off the Fed's balance sheet as much as possible. Now, Warsh was the Fed governor during the financial crisis and supported these balance sheet expansions as emergency measures for sure. Now, he's also argued that the Fed should have been more deliberate about reversing this trend once the conditions improved. And this is what we find with anything that's given out to businesses or given out to people is, don't take it away. Ultimately, you have to take it away sometime, or it just continues ongoing. You can see a number of different governments programs that probably should have been squashed, decades ago. But if you allow them to keep on happening, then, people don't want them to go away, and then you need votes and all this other stuff that goes on with politics, which we try to stay out of. But reducing the balance sheet often is called quantitative tightening. Now, you're very familiar with quantitative easing, which is what we just went through. Quantitative tightening involves allowing securities to mature without reinvestment, So they just expire. They're just done. They did their job. Or, actively selling assets if that's what you want to do. But there is a deadline. There's a timeline on many of these treasuries. And right now, they're either selling them or they're just letting them expire. And now how the Fed will change its communications, the policy-making process, and the balance sheet is not really fully clear at all. But I wanted to mention it because the policy changes could lead to tighter financial conditions. Interest rates might be raised. It could happen for sure, as much as everyone was talking about just lowering 6 months ago. The economy will dictate that. The movement, the data will dictate that, and a new Fed chair will dictate that. So for the long-term investments, this could really affect bond prices, mortgage rates, corporate borrowing costs, and a number of other things. But the fact that Fed may provide less guidance might reduce the Fed speak, which I'm all for. I think we all are in the investment world. We don't need a Fed governor out of somewhere that we don't even know who they are or what they're doing, talking about smack of something about they believe this or they believe that, and it moves the market. You know what? We always in sports used to talk about it stays in the locker room. In my opinion, a lot of these Fed chairs need to just stay in the locker room and not be so vocal. But I know that's tough for them because they have the ability now on socials to get clicks. So, this could also create a lot of uncertainty about how the Fed might react to any new developments. But the broader lesson in all this, as we close up here at the end of the show, the broader lesson is that the Fed's approach to monetary policy is really not static. It's always moving. We know this. It's been in revisions, new research, political considerations, the judgment of individual chairs, for goodness sake, as I mentioned. And for long-term investments, it's really important to remember that the Fed is only one part of the overall picture. The underlying trends driving the economy, many of which are positive today, which I mentioned, are ultimately what allows portfolios to support financial plans, which is what we're here all about, is planning, making the plan, building the plan, and following through. So the bottom line is the Fed's never evolved under different leaders over the past several decades. It's been the same. Now, while this is important to understand, maintaining this portfolio construction and financial plans is still the best way for investors to achieve long-term goals. It's going to be interesting. It's basically my whole point here is okay, there's a new sheriff in town. We'll see where this goes. I think there's some things that are going to be certainly improved. I've already seen major moves, as I mentioned already. And so things are changing, as to quote Bill and Ted's Excellent Adventure. It's not every day I get to quote Bill and Ted. There's something afoot at the Circle K. And you might want to keep watch because it might affect you financially. And happy to do that here and sort of update everybody on what's going on with the Fed. So keep an eye on it as a long-term investor. Keep your eye on the prize and keep on investing. As we always say, always be serving, always be learning, always be investing, and that you will equal a life fulfilled. So I hope you enjoyed today. Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm here locally in Valparaiso, Indiana. You can reach me at 219-246-2516 is the office, as well as email greg@farrellwealth.com. I'd love to hear from you and really appreciate all the insights everybody has. You can also find us on Apple for our YouTube or for our podcast, Apple, Spotify, YouTube channel, you name it, and all of our socials are at Farrell Wealth. We'd love to hear from you. Thanks again for listening today, and I hope you have a very profitable and fantastic week. We'll see you.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.